Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's mission, we debrief two asset classes that form the foundation of every market, stocks and bonds. We'll ensure you understand their fundamental differences. You'll meet bull and bear, two developers both trying to build the identical $20 million apartment complex. Same goal, same capital needed, but completely different funding strategies. One uses stocks, one uses bonds. So get up and watch what happens. First, meet Bull, the optimistic stock developer. He needs $20 million to build his 20 apartment complex. He issues 1,000 shares priced at $20,000 each. He invests $10 million of his own money, giving him majority control, and sells 500 shares to outside investors. The total raised is $20 million. Bull owns 50% and investors split the rest. Every shareholder now owns a piece of that apartment complex. Month 1 passes. Construction is well on the way and apartments start taking shape. Shareholders get excited. Their ownership becomes more valuable. Some sell their shares to each other at $22,000, booking 10% gain. Others hold, dreaming of the finished project. Month 6 passes. Complex is now 50% complete. Share price climbs to $28,000 as rental income prospects clarify. Trading volume surges. Shares changing hands daily. Demand drives prices higher, boosted by media buzz when a celebrity buys the penthouse. Month 12. Apartments finished. First tenants move in. Bull announces first profits. $2 million rental income. He pays shareholders $2 per share dividend. Share price jumps to $35,000 on profit announcement. 2 years pass. Complex thriving. Annual profits now $4 million. Bull pays $4 per share dividend. Total shareholder return 75% from initial $20,000 investment. Now let's take some key takeaways from the story. Shareholders are owners. They profit when Bull succeeds, but total loss possible if Bull goes bankrupt. Unlimited upside, unlimited downside. That's what a stock is. Partial ownership in a company. You hold equity. When the company grows, share price rises and you profit. The opposite is also true. When the company struggles, share price falls. That is the foundation of capitalism. You risk capital for business participation. Important thing to remember is the stock price reflects, or at least it should reflect, company performance and future earnings potential. Better results equal higher price. You'll often hear priced in, meaning the market already factors expected future events into today's price. Investors hunt undervalued stocks where market price underestimates earnings power. At this point, also take note that different share classes exist. Some limit voting rights or profit participation. Common shares typically have both. You should always check before buying so you are aware what you are actually buying. Now meet Bear, the conservative bond developer. Same apartment complex, same $20 million needed, but Bear decides for a completely different approach. He decides he will issue 500 bonds at $20,000 face value each. Total raised $10 million. Each bond promises 4% annual coupon payments for 3 years, then repays the $20,000 in principal. Month 1. Bear pays first 800 coupon per bond, that is 4% out of 20,000. Investors are happy, guaranteed income regardless of construction progress. Their only risk is Bear going broke, but with his citywide portfolio, he is known in the investor circles as AAA. Month 6. Construction is going slow and behind schedule. Bear realizes he needs $10 million more to finish the project and issues the second round. 500 new bonds at $20,000 face value, but now at 5% coupon because investors demand higher yield for construction risk and the delays. Secondary market adjusts immediately to the new bond issuance. Initial 4% bonds now trade at discount for $18,600. Why? Because there is competition from the 5% bonds. Why pay full $20,000 for 4% yield when new bonds offer 5% at same price? First year passes. Bear pays second 800 coupon on original 500 bonds and 1000 coupon on new 500 bonds. Original bondholders get promised payments despite grumbling. 3 years pass. Complex finished. Bear repays 20,000 principal plus final coupons to all 1,000 bonds. Original investors made 12% total return, which is 2,400 coupons on 20,000 over 3 years. Steady, predictable. Now let's go through what bonds actually are. Bonds are a debt instrument. In exchange for the invested capital, buying the bond, fixed payments are promised regardless of the business success, with repayment of the invested capital in full at maturity. That's what a bond is, a loan to a company or government. You get fixed interest payments, coupons, plus principal back at maturity. Some of the key terms to remember. Face value. That is the value of the issuance amount. In the bare example, 20,000, known as the principal. Coupon. Fixed interest usually paid out semi-annually. Maturity, repayment date. Your biggest risk as a bond buyer is similar to the shareholder, company going bankrupt. Bankruptcy loses principal. The upside, on the other hand, is completely different. As a bondholder, your upside is capped. You have no participation in profit. Lower risk, lower reward. Another point from the story. When Bear issued higher yield bonds, original bonds lost market value. Same happens in real life. If interest rates rise, existing bonds fall in price. You might have heard the phrase, when the price goes down, yields go up. Don't get confused by that. It's just simple math operation. If 1,000 bond has 4% yield, that means $40 of interest payments every year. If the bond price drops to $9.60 on open market, you still get $40 of yearly interest, except now $40 is not 4% but 4.1%. The amount of interest you get is still the same, and if you hold your bond to maturity, you will still get full 1,000 back. And how do you know if the company or government is good for their bond? Usually this is where rating agencies come into play, as they give ratings in relation to how likely it is they will default on their debt. But don't blindly trust, do your own research. Just remember GFC when everything was rated AAA and we all know what happened next. On screen you have a field card for a quick side-by-side comparison of the two asset classes. Take a screenshot for your future reference. Let's recap this mission. Bull represents stocks. Ownership, unlimited upside, exposed to daily price swings, profit participation. Bear represents bonds, loans, fixed payments, lower risk, creditor priority. Most beginners don't grasp this difference and chase safe stocks expecting bond-like stability. Now you know better. On our next mission, we debrief another foundation, how the stock market actually works. Buyers, sellers, brokerages, exchanges, market makers. The mechanics behind what really happens from the moment you press buy on your phone app to the moment you see the share in your account. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.